Okay, what is implied volatility? Okay, that's a good question. So, implied volatility is to be a very to give a very rough overview. So let me explain that. So, to explain implied volatility, let me explain volatility. So, volatility is, let's say you have an asset. Volatility typically helps you understand how much does the asset fluctuate. If the asset is fluctuating lower, the volatility will be lower. If the fluctuations are higher, the volatility will be higher. So one of the common things to understand what is the current volatility is people look at VIX levels, right? So if I just quickly Google search VIX, it will show me the VIX for S&P 500. So currently the VIX is 31. It's an annualized number. So basically we can interpret this as that market is expecting that it will move 30% above or below. There could be the fluctuations in the S&P 500 prices. Okay, so when there is extreme panic in the market, as currently is, because everyone in US is expecting forecasting recession. In fact, if you read Jamie Dimon's recent interview, he said like hurricane is coming, so which he's implying that there is a recession, and all this fear gets captured in the market and everyone starts panicking, and they think that market will fall, and therefore the VIX level rises. VIX in the sense they will expect that this level, like 31%, there'll be a fall in S&P 500 over next 1 year. So when things are people are expecting like the market is going to go south, there's going to be a lot of panic in the market, and typically the what the option seller will demand is they will demand that I want higher premium, right? So for example, if S&P 500 is at 3000, let's say, if I want to sell a put option of 2500, right? So I will not sell this put option very cheaply, because if the market falls by 1000 points, I will incur a loss of 500. So I have to factor in that probability. So when everyone in the market says that there is a lot of fear, the market is going to fall, as an option seller, I will demand higher premium for this particular option. So let's say on this normal days, if this was trading for $5, because there is so much panic and the probability of the stock falling is much higher, I will demand a higher premium, which is, let's say, a $10. And why is this premium rising? Because I expect a higher volatility. I expect a higher VIX level, and therefore this premium is rising. So you can say that option price is a function of implied volatility. If the implied volatility is higher, I will demand a higher premium. And if the implied volatility is lower, I will demand a lower premium.